In this section, I'm introducing another current asset, receivables. And the receivables are claims against customers and others for money, goods, and service. So receivables can be in the form of cash, like money, or any other assets or services. So the most common receivables is in the form of payments. Regarding the source of receivables, the receivables mostly are generated from trade. So we call them trade receivables. So for example, a credit sales. So in the credit sale agreement, the firm delivers products and the customer delayed their payments. So the firm will recognize a receivable against the customers for the payment. Besides trade receivables, there are also non-trade receivables. Basically, the receivables are not from sales, it's from other sources. For the trade receivables, depends on their agreement. If it is oral agreement or written agreement, the receivables can be classified as accounts receivable or notes receivables. In this slide, you will see a list of non-trade receivables as examples. They represent the claims against officers or employees, subsidiaries, insurance companies, government, carriers, creditors, customers for refundable items. In this slide, we have two examples how the firm report their receivables in the balance sheet. And because both firms have both trade and non-trade receivables, so they report them separately. This firm report trade receivables here, this firm report trade receivables here. Non-trade receivable and non-trade receivable. There are two non-trade receivables. Okay, yeah, this one is specified. And also, both report another account, which is a control account of receivables. Yeah, the name is allowance for doubtful accounts. Okay, why? Because accounts receivable represents claims against customers and other parties. But don't forget, accounts receivable may not be received or may not be collectible. So there's potential risk some amount of the accounts receivables will not be collectible. So for this, we should write down the value of accounts receivable. Okay, so the difference is also called realizable value of accounts receivable. So in this example, this number represents the net receivables. This is the balance of allowance. Okay, so in this example, this is the gross amount of accounts receivable. Subtract allowance for doubtful accounts. This is net receivables. So the recognition of accounts receivable generally is from, especially trade receivable, is from sales or revenue. Right. So if the firm recognizes revenue, if the sale is also a credit sale, it will recognize accounts receivable simultaneously. So the recognition of accounts receivable is very similar to the revenue recognition principle. So here is a list of the the requirement for the recognition of an accounts receivable. Has a right to the payment from a customer, pass the legal title of the product to the customer, transferred physical possession of the goods, no longer has a significant risk and rewards of ownership of the goods, and the customer has accepted the assets. Basically, the revenue is recognized. At the same time, if it is credit sale, accounts receivable will also be recognized. The journal entry for a credit sale is we first recognize accounts receivable and also recognize revenue because it meets the revenue recognition principle. Okay, so we recognize revenue here. Because it is a credit sale, we recognize a claim against the customer. And the revenue and accounts receivable are same amount. So in the balance sheet, stockholders' equity increased because the revenue recognized. The assets increase because accounts receivable is also recognized. The amount of accounts receivable is generally the transaction price. There's still some other future events we should consider to value accounts receivables and revenues. They are including discounts, returns, allowance, rebates, and performance bonus, because these will decrease revenue and also the amount of receivables. Here, I introduce two different discounts. First is the trade discount. The trade discount is a discount before the sales. Okay. So the purpose of a trade discount is to promote sales, to encourage customer to come and buy. So that's what you see, when you went to a store, there's a tag like buy one get one free, buy two get one free, 50% off. So these are all trade discount. The trade discount will not be recognized. Okay, so all the sales revenue will be recognized after the discount. So the trade discount will not be recognized in the financial statements. Okay, because the number we recognized or recorded after trade discount. There's another discount we call sales discount or cash discount, and this is discount after the sales. So the purpose of cash discount is to promote or encourage customer to make payment earlier. And cash discount is only available for credit sales. This is usually between business and business. Okay. And there are some terms, like for example here, we read it as 210 net 30. The meaning of this term is if the customer make the payment within 10 days after sales, the customer will have 2% off their payments. Otherwise, the payment should be made within 30 days after the sales. Okay, so this is the 210 end of month. This is net 30 end of the month. Okay, different terms represent different offers. And to record the cash discount, because cash discount is after the sales, so it will affect both sales revenue and accounts receivables. So we should recognize the cash discount in the financial reporting. There are two different methods, gross methods and net methods. In the next slide, I'm going to use an example to show you what's their difference. In this example, the credit sales amount is 10,000. Term is 210, net 30s. For the gross method, okay, the cash discount or sales discount will not be recognized unless the customer takes the offer. For example, the sales, right? When the sales takes place, the firm recognizes accounts receivable and sales revenue $10,000. And the part of the payment, $4,000, are paid within the discount period, so there will be a 2% off, right? So the 2% off is $80. So the customer actually pay $3,920, or the firm receives $3,920, and the accounts receivable is written off by $4,000, and this is a sales discount. And the other payments is after the promotion period, so there's no more discount. The customer make $6,000 cash payment, and the accounts receivable will be written off. So the total 10,000 accounts receivables are written off. Net receivable is different. Okay, it assumes the customer will take all the discount beforehand. So that's why the accounts receivable and the sales revenue is recognized as 9,800, because this is a 2% off. Basically is 10,000 subtract 10,000 multiple 2%. Okay. During the promotion period, the firm just recognize whatever the firm make the payments. Okay. And here we know the customer only make $4,000. And here we know the customer actually paid $3,920, only take $80 off, right? Actually, there will be $120 discount, which was forfeit. So in this, after the discount period, we're going to debit accounts receivable and recognize $120 as sales discount forfeit. And this is another payment. Okay, so the difference is gross methods is more conservative. So net method is more conservative because it will reduce the sales revenue and accounts receivable beforehand, no matter how much discount the customer take. Okay. Here is another example. The sales is $2,000 with the term 210 net 60. Sales was on June 3rd, and the payment is 9 days after. So that means the company takes the discount. So if we use gross methods, we are going to report the gross sales, which is before discount. So debit accounts receivable, credit sales. Because the firm, the client, takes a discount, so actual payment, the debit cash is 2,000 multiply 1 minus 2%. And the accounts receivable written off is $2,000. There's a $40 sales discount, which actually will decrease the sales revenue. So in the income statement, the sales is reported as $2,000 and will less sales discount 40. So the net sales is $1,968. Okay, so in some firm's financial statement, you will always see the top line net sales. That means it is, after subtract the discount from the sales. If we use net methods, we're going to report the revenue after the discount. Actually, it's $2,000 multiply 1 minus 2%, It's 1,960. Okay, so this is sales after discount. No matter whether the firm takes a discount or not. If not, discount will be forfeit or partly forfeit. If it take, we just debit cash and credit accounts receivable. Okay, so this is actually what? The net sales. Okay, so that's the difference. This is the same question. We still use net method, but the assumption is the customer did not remit payment until July 29. Okay, which actually is after the promotion period, but before the 60 days deadline. So in this case, again, we debit accounts receivable, that's a net sales, net receivables, and also net sales. Because the customer make the payment after 10 days, so there's no discount was taken, so the customer has to pay the gross amount of the sales, or the company should receive $2,000, and the receivable written off is the receivable after discount, and the sales discount forfeit is $40.